So, hello guys. So, as you guys know, uh, I recently saw a movie called Big Shot. So, it is based upon not Lehman Brothers actually, about 2008 financial crisis. So, I wanted to tell you about 2008 financial crisis without getting into more specific things. But I want to make sure you understand by the perspective of an engineer without getting into any graph, data, anything. So I want to tell you how people made money and who lost and who won. So basically, the home ownership, it is an American dream. So they made an PR movement basically. So about how Americans should live. They should have their own car. They should have their own bungalow. I mean their own home, and they should have a financial stability. That was basically seen as an American dream, and many immigrants from US, sorry, many immigrants from Mexico and India, Canada, and many South American countries people started immigrating to US. So, to achieve American dream, they should give free loans or less loans, not free loans basically. So, let me tell you what happened. So, as you know how financial works. So, basically, it's you, it's government, it's bank, and it's home. So, bank gives you a loan of 1 million and you pay it back with interest, and you get to keep your home. So, if at all you are not able to pay the loan, you are giving the home back to the bank, and they'll be selling it in other, and they'll make some money out of it. Maybe they will not be able to recover a lot of money, but they'll be able to recover some of them. So that is basic of economics. So I hope you guys understand this basics, because you have seen this around a lot. Maybe your parents have bought an house or they are constructing a house. So that's how it works. So this is the second part. So suppose there is a bank that has paid you 1 million and you are paying it back 1 million plus interest, and you have a home. So this is known as mortgage. So what happens? A bigger bank, the bigger bank will come here and give you will buy this mortgage, and they will give the money upfront along with interest or whatever that was supposed to be paid. This will be paid upfront, and what will happen? The mortgage will be given to the big bank. So basically, you are giving the mortgage directly to the big bank. That means 1 million that will be eventually recovered less the interest. You get to keep the home. This is how it is supposed to work. So that is the assumption that no one will be default on their loans. So that is what is currently they were thinking of it. But as you know, economy is not always straight. So many people do default. So I will tell you what is it. So in this slide you have seen that all the mortgages are given by the big banks, taken by the big banks. So what will happen? The big banks will create a whole entity that is one company under itself, and they will release the shares like this. They will release the shares of all the mortgage that is there. One of the mortgage will be this, one mortgage will be this, one mortgage will be this. So this is a block, and there are many blocks under this. So there are many investors who are willing to buy the shares. So as you know, by the share market, how it works. So whatever the profit you have made, it will be shared among the shareholders or the investors. So that is basic of economics. So let me tell you how this works. So suppose there is an entity that big bank has created, and they have divided into three parts. So this is the green part, and this is the orange, and this is the blue. So what will happen? This is the risky. So whatever the mortgage they think is very risky, So they will put it over here, and whatever they think that is moderate risky, they are able to pay back. Maybe one or two interest they might have missed, but they are paying back. So that is the moderate. And maybe what will they think? Maybe some of them will they are paying the interest on time, and they are making consistent payment. That is the safest return. So what will happen? The shareholders will buy this at $10 maybe. So, and maybe it is per share of this is cost around $20, and maybe here it will be $50. So as the entity shares increases and profitability increases, the people who have taken the per share at the lowest will profit more. This is risky, but it has a high return because they have bought it for less amount. And this is moderate but medium return. This is the safest but low return. This is how it should have worked. Okay, but I will tell you what happened. Okay, so what happens when loans are not paid, and what happens when house is taken and they have sold in distress sales, and some money will be restored, some will be not restored. That is risky, very risky. So they have categorized this into many shares, that is AAA, BBB, BB, like that they have categorized, as I told you. So okay, okay, good. So yeah, I will tell you how loans were given. So loans were given at 2% teaser rate and adjustable rate at that point of time. So for some years it will, or the interest will be only 2%, and for after that it will be adjustable rate, that is decided by their own country interest rates. So that is how it used to work. People started taking massive loans thinking that they are able to cope by 2%, they will be able to cope by adjustable rate also. Okay, so that is what maybe you might also think. So for some time it worked. So I will tell you how it worked. So after 2% teaser rate, American government made sure that their adjustable rate, interest rate will be low after the war and after a lot of things happened. So what they did to stimulate the economy, they started reducing the interest rate so that people have lot more money to spend and their economy is stimulated properly. It is like an oil engine. So it started working pretty well for them. And after some time what happened, I will tell you. So after that time, when the economy started growing very fast and people were not able to cope up with that, it created an hyperinflation. That means prices are going very up, but people are not able to buy the product. So what they did, they started increasing the interest rate so that there is not less money in the hands of people. So it also had an adverse effect in adjustable rate. So in adjustable rate, so as immediately it increased, so people were not able to pay as much as possible. So they started getting default. So there was a person called I will tell you his name. Okay, Michael Burry. So Michael Burry, what he did, he started, because these all of them are shares, they are listed in stock markets or SEC filings. So Michael Burry started digging into SEC filings and found out that people are defaulting on their loans. But many banks were dumb enough to look into that. I will tell you why. Okay. So you saw this, right? So banks are buying mortgage, big banks are buying mortgage from the small banks for the upfront money. So what did small banks thought? They thought, let us do one thing, let us start issuing loans as much as possible so that big banks will buy from us and we get upfront money while putting mortgage into big banks. So they are taking very less risk by giving the mortgage to big banks. And also they while categorizing the risk, so as you know that as a less risky assets are cost less, so big banks will buy cheap, so they started pushing the bad loans as very good loans and started providing them these things. They started getting more money, so that is how they became very greedy, and they started doing all those stuff. Okay, so I think you guys got to know a lot about what happened. So I will tell you what went wrong. Okay, so in this slide I won't bore you anymore. So they have a this thing called when people start defaulting on their loans, they start cutting from here. They will start cutting the everything from here, so it comes from here. So as if they think that considerable loans of here are defaulted, they will start cutting it from here, then here. So that is the reason it is very risky. So uh, they started okay, so everything was a bad loan. So as they try to push some bad loans into these good loans, this is also bad loan, this is also bad loan, this is also bad loan. So basically everything is a bad loan. So once people start defaulting, the whole share is waste. So everything is waste. So what happened? So it happened with the Lehman Brothers. So what did Lehman Brothers do? They started buying all this. They started buying all the loans, that mortgage loans from small banks. So they thought they will make some profit but everything was a bad loan. So when people started defaulting, Lehman Brothers didn't have any money to buy everything. So that was an error in their point. So they defaulted, and the insurance company that backed Lehman Brothers and other companies who were buying mortgage from the small banks, also AIG or AGI, something I forgot. Okay, so American General Insurance, I guess, but they too started collapsing. So everything collapsed. So as banks defaulted, as everything defaulted, it created 2008 financial crisis. I think you understood what actually happened without getting into statistics, without getting into anything. This is point of engineer, so I think like, subscribe, anything you can do.